Hey there, Dominique Henderson here, your friendly YouTube CFP. Want to talk about reverse mortgage today. I remember when I first heard the term, I was like, what is a reverse mortgage? And you may have had some of those questions. So I want to go through some of the answers to a couple of the questions that I've ran across in talking about this subject and understanding it a little bit more. So what is a reverse mortgage exactly? I think the best way to explain this is to give you an example. Let's say you buy a house, right? You buy a house, it costs you $100,000. And let's say for simplicity, you're going to borrow all the money to pay for the house. That doesn't usually happen, but for simplicity's sake, you borrowed $100,000. Well, 10 years later, two things are going to hopefully happen. The first is that your $100,000 of principal that you borrowed is going to go down because you've been paying off the loan. Let's say that's $50,000. And then the other thing is, you hope, is that your house goes up in value. Let's say it's gone up to $200,000 in value. So what do you have now? You have the difference between 200,000 and 50,000, which represents 150,000 of equity you have in the house. The problem is you can't have this equity. You can't realize it. You can't sell unless you sell your home. That's the only way you can realize that 150,000 in equity minus fees and whatnot. So this is where a reverse mortgage comes into play. If you're over 62 years old, you don't have to have any income verification. All you need to do is have that 150,000 of equity, and you can access the equity in your home through a reverse mortgage. Now, exactly how does that happen? Well, you can get the whole $150,000, or you can get some payments of the $150,000 over time, or you can just have a line of credit that you have access to. It's a lot of different options here. We're not going to go into all of those. So you may ask, well, Dominic, how is that different than just getting a home equity line of credit or a home equity loan? Well, the first thing is you don't have to have good credit in order to get a reverse mortgage. It's not dependent upon your credit or whether you have a job. It's just dependent upon, do you have more than 50% of equity in your home? Now, there's going to be different rules by each state, but generally speaking, those are the requirements. And you have to be living in that home as your primary residence. As long as you're 62 years or older, living in the home as your primary residence and have more than 50% equity in your home, you can use this product. All right, that sounds too good to be true. And maybe it is. Let's give you the downsides. This is both the pros and the cons. I want to give you equal parts of judgment and opinion on this. Okay, one particular downside is that the home, once you pass, the loan balance has to be paid in full, right? So in a reverse mortgage, that $150,000 of equity is being given to you as a loan by the bank, and that loan has to be paid back. Remember, even though this is $150,000 of your equity, the home, until it's sold, that money does not come to you. So the only way for you to access it is through a loan. So the other part is that if you pass away and this loan becomes due, let's say that for whatever reason, while you're getting these payments, or when you got the lump sum years ago, that the home went down in value. So you're faced with this dilemma of the loan balance possibly being higher than the value of the home, in which case it means you would have to write a check just to sell your own home. A couple of other things that you may want to consider is there's been a lot of scams because this is a fairly complex financial instrument. And the more layers of complexity that you add onto something, the more opportunity for people to try to hoodwink you and try to scam you out of your money. The other thing you want to consider is that these are not the cheapest products. They can be anywhere from 2.5%, or 3% annually that you're having to pay in order to access these funds. And then just more practically, what happens if you get that $150,000 at age 62 and then you live to age 95? How do you know that that's going to be enough of money for you and what you need? So let's talk about why this might be a good product or a bad product for you. Well, I think this could be a pretty good product for you if, let's say that a lot of your net worth, the majority of your net worth is tied up in your home, and you really just want to live there. You don't want to go anywhere else. Maybe it's going to be the home that you pass away in and that you live the rest of your days, but a lot of your net worth is tied there and you're a little cash tight. This could be a perfect product for you, a perfect solution for you to fix the cash flow problem. On the other hand, that if you feel that you may end up going to a different facility to live out your days, or you want to pass on your home to your heirs, that this is probably not the best product for you. You just want to think down the road about how the value of your home may change and all these different things. I don't know that it's the best solution if you want to pass your home down to your heirs. The other thing you just want to think about is just the logistics and the math of this. Whereas in a traditional mortgage, you have an asset like your home, and then you have a loan against it, which is the mortgage. Every payment you make goes down to reduce the principal and pay back a little bit of interest to the bank, to the person that loans you the money. Whereas in a reverse mortgage, the opposite happens, right? So instead of you making payments that are going to reduce your loan balance and therefore increase the equity you have in your home, the reverse is happening. That's why it's called a reverse mortgage. Payments are being made to you, or that lump sum is being given to you, in which case you're increasing your loan balance and you're decreasing the amount of equity in your home. You just want to kind of think of the fact that you are monetizing your equity right now, right? The whole point in building up equity and asset is to eventually monetize it. So the only way to truly monetize it is to sell it. But if you want to take a loan against it, that's up to you. And that's what a reverse mortgage is designed to do for homeowners over the age of 62. In final considerations, I would just say this. On one hand, you may be over the age of 62, maybe you're headed towards retirement, and you see that you haven't saved enough for retirement, and you're trying to fill that cash gap that you might have. And you've got a considerable amount of equity in your home. You don't plan to pass on that home to your heirs. That's not a primary concern. And this home will probably be the home that you pass away in. This could be a perfect solution. You may want to talk to a mortgage broker at your local bank to figure out if this is something that you would want to use in your retirement solution. On the other hand, if you've got plenty of assets, you've got money in a 401k, you're not going to really have any cash flow issues. You would rather keep the home in the family. This is probably not the product for you. You really don't need it. I would say this is usually for people that need to spend down their assets all the way down and don't really consider or won't be considering leaving behind an inheritance for their heirs. Okay, that wraps up this episode of Office Hours and Reverse Mortgages. Look, if you have additional questions, leave them down below in the comments section. I would love to answer anything that I can. Also, consider subscribing to the channel. Give us a thumbs up if you liked it. We'll see you back next time. Bye-bye.